You know, the more I've traded over the years, the less I trade individual stocks. I trade a lot more futures and a lot more ETFs now. I think this is a natural progression with a lot of options traders, is just because individual companies are dangerous, right? And it's not dangerous in terms of, you know, sometimes you make a bunch of money on a big earnings move. Sometimes you'll lose a bunch of money on a big earnings move. It all evens out in the end. But at the same time, Oracle, I mean, the stock market just opened a few seconds ago. Oracle just gapped up about $80 on earnings, right? This just ran over a lot of people, right? And if you've ever taken one of these kinds of beats on a short call or short strangle, you know, on a stock that made this kind of huge up move, or on the downside, had some short puts that got murdered, you know, where a stock drops 20, 30%, you know, on earnings. And again, if you play these stocks all the time for earnings, the winners and the losers, they'll even themselves out, but still, it's a bumpy ride, right? Because of the huge P&L swings. And sometimes you just want things that don't make the crazy moves. And for me, that's why when I look at my positions, I go to my positions tab right now. What individual companies am I in? Well, the ES futures are not a company. That's the S&P 500. Crude oil's not a company. MES, that's all the S&P 500. ARKK, that's an ETF, a basket of stocks. That's not a company. Webull and Cleveland Cliffs and Coinbase, all three of these are actually companies. EWZ is the Brazilian market. GDX is the gold miners sector ETF, not individual companies. Helms and Hood are companies. IBIT's an ETF. Nike, ON Semiconductor are companies. QQQ, SCHA, SCHD, SCHG, SPY, all ETFs. Target's a company. VIX is an index. HHB is a sector ETF. So of all these underlyings that I've got positions in, 7 or 8 of them are individual companies, and the rest are ETFs or futures or index products. Now, why is that? Well, I don't have that risk on those things like you do with an individual company. They're never going to make that gigantic move because of an earnings event. For example, Oracle. I don't know what kind of percentage Oracle makes up of QQQ, you know, the NASDAQ ETF. But if I go take a look at the chart, NASDAQ gapped up a little bit this morning. It didn't make a crazy gap up, though. It didn't gap up here the way Oracle did, you know, trading the one company. So when you're trading baskets of stocks, like with an ETF or any of the index products or the sector ETFs or whatever it happens to be, you smooth out things a little bit. Yeah, though you don't get the crazy moves that, you know, you'll hit a home run and make a huge profit, but you also not going to have that crazy unexpected outlier move that's going to cost you thousands and thousands of dollars either. So it just smooths things out a little bit. And it's a nice place to be. Now, typically when you trade market ETFs, sector ETFs, the volatility in these will be much lower. IV rank will be much lower. The IVX will be much lower. You know, they just don't move the way those individual companies do. But again, a lot of traders, this is what you want. You want smooth sailing, right? You don't want the big up and down, the big moves, right? You want a little less volatility in your life, especially when it comes to your P&L. So these days when I play earnings, I mostly play them really small, and it's usually just the biggest companies like the Mag 7 type stocks. And it's usually small plays, spreads, iron condors. You know, I'm not trying to take a big swing on anything. They're mainly, hey, I know Nvidia's reporting earnings or Microsoft's reporting earnings. I just want to play along, just to follow along with the event. So I'll spend a couple $100 on some cheap little play, but I don't take any real risk on these kinds of things anymore. Not as much as I used to. One of the other things we should talk about is rolling, because there's going to be a lot of people with these Oracle trades that are going to need to roll. So if we go back to the chart with Oracle, damn, Oracle's up now about $85 on the day. But yeah, people are going to need to roll, you know, their strangles or whatever into new positions in Oracle. Now, should you do that? Should you just take the loss on the trade? or should you roll and try to defend it? This is a question. This is not just for Oracle, but all these trades that go against you. Anytime something crazy happens, hey, what do I do? Should I roll? How do I roll? Should I just take the loss? Now, this question here, should you roll or should you just take the loss? It's kind of a misleading sort of question, because when you roll, you're not actually avoiding the loss. When you roll a position, you're closing your existing position, which is a losing position, and you're opening a new position. All you're doing is you're carrying over that P&L, your unrealized loss on the P&L for the first trade. You're just taking it into the new trade, but that's all it's doing. You're still down the money, right? And you still have to recover that money in some way. Now, whether you roll the position and stay in this underlying Oracle in this case and try to make the money back in Oracle, or should you go open a new trade somewhere else, try to make your money back somewhere else? It depends. You'll have to make that decision. But when it comes to the idea of should I close the trade or should I roll the trade, there's some things you need to consider. And this is something I don't think enough options traders consider when they're making these rolls. Is think of the new trades you put on. What do you look for when you're putting on a brand new trade? So I've got some money to play with. I've got some buying power today, and I want to go make some new trades. What are some of the things that I get to pick and choose? Well, I get to pick what underlyings I want to trade, as far as the ones that I like to trade. I get to, the ones that are the most liquid. So liquidity is a big thing. I get to go and pick and choose which ones have good IV, especially as a short option seller. I filter out stocks that have good IV. I get to choose the time frame I'm in, as far as the DTE I like to trade. I get to pick and choose a lot of different factors. There's probably 6 to 8 criteria when I'm going and opening a new trade for the first time. You guys see me put on new trades all the time and see my thought process. And you guys, of course, have similar thought processes as far as when you're putting on your new trades. But here's the thing. When you're rolling a position, you don't get to do any of that, right? You don't get to go and, choose the underlying. You're already in the underlying. You don't get to go really. You don't have much choice in expiration either. You're typically just rolling out to the next month. That's basically all you can do. You don't get a choice as far as which stocks, as far as IV rank and things like that, because you're already in this position that you're trying to defend. So if IV rank went from 50 to 5 today in Oracle, but you've already decided to roll, well, you're going to be rolling to a new position, say a new strangle on, with a stock that now has an IV rank of 5. Not something you would put on as a new position. So this is the problem with rolling, is with rolling, you're rolling into basically a new position, but you're not doing it the way you would if it was a brand new position without the roll, right? Because you're not using the same filter system. You're not doing it using the same criteria you would for a new trade. And I think this is dangerous. When you're rolling these options trades, make sure that you end up in a trade that you wouldn't mind putting on as a new opening trade, right? Because a lot of times people will roll and they end up in trades that they really don't want to be in anyway. So if the roll doesn't make any sense, like if you're trying to defend some trade today and you roll into a position and you're like, damn, I don't like the IV rank on this stock with this strategy. I don't like the deltas I'm in. I don't like anything about, I don't like the risk reward on this trade. Well, if it doesn't make any sense, then the roll doesn't make any sense. Just close this trade, because again, the roll is just, you're taking the loss and putting it, that P&L into a new trade anyway. Well, if the new trade for the roll doesn't make any sense, just don't take the roll. Close this trade. Go find a new trade, a better trade in a different underlying. Go make that money back somewhere else if you need to. So that's something to consider.